February 26th, 2026. 4,000 people wake up to discover their jobs no longer exist. Not because the company is failing, not because of a recession, because according to their CEO, artificial intelligence can now do their work better than they can. Block, Jack Dorsey's fintech empire behind Square and Cash App, just executed the largest AI-attributed mass layoff in tech history. Wall Street's response? The stock rallied 27% in after-hours trading. This isn't a story about automation. It's a story about what happens when markets reward a narrative before anyone checks if it's actually true. Here's what everyone believed that morning. AI had finally crossed the productivity threshold. The tools weren't just augmenting workers anymore. They were replacing them at scale. Jack Dorsey posted his announcement on X. We're already seeing that the intelligence tools we're creating and using, paired with smaller and flatter teams, are enabling a new way of working which fundamentally changes what it means to build and run a company. He was explicit. This wasn't a cost-cutting measure driven by financial distress. Block had just reported gross profit of $10.36 billion for 2025, up 17% year over year. The narrative was irresistible. 40% of the workforce, gone. From over 10,000 employees down to under 6,000. And the company framed it as evolution, not desperation. Analysts jumped in. One leveraged shares report predicted that within the next year, the majority of companies would reach the same conclusion. The implication was clear. Block wasn't cutting jobs. Block was showing everyone else the future. By market close, investors had added $2.7 billion to Block's market cap in a single trading session. But here's where it gets strange. If AI could replace 40% of Block's workforce overnight, that capability didn't appear on February 26th. These tools had been available for months. ChatGPT-4, Claude, GitHub Copilot, the exact technologies Dorsey credited, had been deployed across tech companies throughout 2025. So why didn't markets price this in sooner? Why did Block's stock trade flat for the previous 6 months if this productivity revolution was quietly happening inside the company? Start with the math. Block employed over 10,000 people. Average fully loaded cost for a tech worker in San Francisco runs approximately $200,000 per year. Salary, benefits, office space, equipment. 4,000 employees, gone. That's a potential $800 million in annual cost savings. For a company with $10.36 billion in gross profit, that's an 8% margin expansion. If those roles actually disappear and the work still gets done. Wall Street clearly believed it. The stock jumped from $54 from 53 to nearly $69 in after-hours trading, a 27% surge that implied investors thought this was real, sustainable, margin-enhancing efficiency. But then, completely ignored by everyone celebrating the announcement, this happened. 3 weeks later, Business Insider reported that Block had quietly rehired at least 4 of the employees it had just laid off. A company spokesperson told them, "We know we got some of them wrong, and we've built in flexibility to account for that and do the right thing for our customers." Read that line again. We know we got some of them wrong. If AI had truly reached the capability threshold where it could replace these specific roles, how do you get it wrong? Either the technology can do the job or it can't. You don't accidentally fire someone whose work turned out to be irreplaceable by an algorithm. And this is the part nobody talks about. There's no public evidence Block had implemented any major new AI system in the months before the layoffs. No product announcement, no infrastructure build-out, no partnership with OpenAI or Anthropic. The company's own earnings report mentioned AI tools improving efficiency. But improving efficiency and replacing 40% of headcount are not the same thing. Here's what everyone missed. In the shareholder letter, Dorsey wrote that he expects the majority of companies to reach this conclusion within the next year. Not that Block had already proven the model works, that he expects others to follow. This wasn't a report from the future. This was a bet on the future, executed on 4,000 people's livelihoods. The bias has a name: narrative capture. When a story is compelling enough, markets stop asking for evidence. They price in the narrative itself. Jack Dorsey, the guy who built Twitter, who has a track record of seeing around corners, says AI has fundamentally changed what it means to run a company. That's not just any CEO talking, that's a signal. Analysts assume he's seen something they haven't. Investors assume Block has proprietary data proving this works. Everyone anchors to the narrative instead of the numbers. It's the same trap that caught markets during the first wave of blockchain hype. Remember when Kodak added blockchain to its business plan and the stock tripled in 2 days? No underlying business change, just narrative. The difference here is the cost isn't just shareholder value, it's 4,000 people who lost their jobs because a market rewarded a story before anyone asked if it was true. Within weeks of Block's announcement, the count of AI attributed layoffs hit 45,000 across tech. According to Rational FX's tracker, more than 9,200 of those jobs were explicitly blamed on AI and automation. Atlassian cut 10%. Autodesk cut roughly 1,000 roles. Every CEO cited the same reason: AI tools enabling smaller teams to do more. Pattern or contagion. When one high-profile company gets rewarded for a decision, others follow. Wall Street doesn't punish imitation, it punishes being late. The question isn't whether AI will eventually replace these jobs. The question is whether it already has, or whether 45,000 people just became the cost of a story Wall Street wanted to believe. Markets don't price in reality, they price in consensus reality. And the fastest way to change consensus isn't to prove something works. It's to make a big enough bet that everyone assumes you've already proven it. Jack Dorsey didn't show us the future of work. He showed us how much the market will pay for a good story about the future of work. The difference between those two things: 4,000 jobs. If this is the kind of story you want to see more of, you know what to do.